The rules of tax in Switzerland are complex. Every canton is different. And between deductions, allowances, and investment income, it's really easy to feel lost. And many people worry they're either paying too much or making costly mistakes without even realizing it. But taxes are also one of the biggest levers for building your wealth and financial security. And that's why I've invited someone very special today for this workshop, Kevin Walz. In this session, Kevin and I will walk you through the hidden fundamentals of Swiss taxes most people miss, the overlooked deductions that could save you thousands, and the biggest mistakes expats and locals make and how to avoid them, and the simple strategies to cut your tax bill without the headache. So grab a notebook because this is going to be an eye-opening hour you will not want to miss. Hello, everyone, and welcome to today's podcast, or let's say workshop on tax in Switzerland. And I'm so happy to introduce you my special guest, Kevin Walz. Hello, Kevin.
Hi, good morning.
Morning. And Kevin has over actually 15 years of experience in taxation in Switzerland with a background in tax authorities, a Big Four firm, and banking. And he's currently independent, running his own tax advisory firm in Switzerland. Hello, Kevin. And maybe we can just start with the Swiss tax system. So maybe can you briefly explain to us like how the Swiss tax system works, the federal, the cantonal, and on the city level as well?
Yeah, you already mentioned it. There are 3 levels of taxes in Switzerland: federal, cantonal, and the so-called communal taxes, like the tax of your city.
Yeah, city. Yeah.
All of them have an income tax, but there is a wealth tax on the cantonal and communal level only. Furthermore, there are some additional taxes like capital gains tax if you sell a property, or taxes for gifts. Both of those examples are only applicable on the cantonal and communal level. Basis for income and wealth tax for all 3 levels is one single tax return, so we don't need to submit 3 of them. There are only minor differences between the different cantons in terms of the deductions, like different limits or additional deductions. Some of the deductions in your tax return are fixed, like so-called lump sum deductions, and others are based on your effective expenses. Additionally, some cantons, there are some unofficial lump sum deductions, which are granted by the tax authorities just in order to work efficient.
Yeah, can you maybe give us 1 or 2 examples when you mention like lump sum deductions?
Yeah, so maybe for the unofficial lump sum deductions, we Zurich, for example, usually grants a deduction for donations. So Red Cross or some other institutions that just grant 300 Swiss francs without any proof, usually. When we're talking about other deductions, there are lump sums for insurance premiums, for business expenses usually. So there's, for example, a fixed amount for each work day that you can deduct for your meals, which is, I think, in all cantons, 15 Swiss francs a day. And there are other deductions which depend on your expenses. For example, the interests you pay on your mortgage and stuff.
Yeah, and this kind of thing you need to file separately, right, as your effective expenses. But previously, what you mentioned is that without a real proof, maybe you can also, put an amount there, as meals, as what you just meant. What did you just mention? The meals and also donations. Yeah, exactly.
So you don't need to to provide them with any statements for your daily meals.
Yeah, today I spent 12, tomorrow I spent 35, for example. Okay.
Yeah, it just makes life easier for both.
Or both. Yeah. Exactly. And Kevin, and what I would say for, let's say for expats, right? Since it could be very confusing, I would say for those new arrivals in Switzerland. So what are the key, I would say, tax considerations expats in Switzerland should be aware of when they, let's say, just arrive?
Okay, so I already talked a bit about the tax return, but not everyone really has to file a tax return. So if you arrive in Switzerland, there are different kind of permits that you can have. And if you have a B permit, for example, the taxes are withheld directly from your salary, a so-called tax at source. And only if your income or wealth exceeds a certain amount, it is mandatory to file a tax return. Taxes on your salary are then still collected, so this tax at source remains. But you may have to pay additional taxes than for other sources of income like interests, dividends, or your wealth. But you could also make additional deductions then that are not included in the withholding tax. If your salary is above a certain amount, which leads to a tax return filing obligation.
Yeah, I think in most cantons it's like 120K, something like
Exactly.
that, right? Yearly. Yeah.
That's it. And usually the tax authorities should be aware of this because they receive the tax at source and they know what your income is.
Yeah.
And they will send you the tax return automatically. If for some reason this doesn't work, you can register yourself or just give them a call, and then you will receive it. But if the reason for your filing obligation is not your income, but your wealth, then you need to register yourself because the tax
Yeah, you need
authority.
to pay the wealth tax. For example, if you have 10 million, I don't know, like even 1 million, you need to pay,
Yeah, and the tax authorities don't have that information, right? They don't receive it automatically from your bank. And this part is often forgotten and can lead to penalties and interests.
Interests.
If you're not sure if you need to file a tax return, just call the tax authorities, explain them your situation, and they will tell you if you have to or not. It's also possible to file a tax return voluntarily, which sometimes can make sense because you can claim for certain deductions, like if you have high commuting costs, for example, if you pay high interests, then it can make sense.
Yeah, on your debt or loan, for example, right? Or your mortgage elsewhere.
Exactly. Yeah, but there it is important that the registration for such a voluntary tax return needs to be done by the end of March of the following year. Otherwise, you'll need to wait for another year.
Yeah, I think the key tip here is like, don't be afraid if you think your case is quite special. It's not, within one of the few cases that Kevin mentioned, that maybe you're multimillionaires in your also, in your home country, and you don't know if you should file or not. Just like reach out to your local tax authority, and they will evaluate your case and give you the right answer.
Yeah.
And Kevin,
maybe
go
if
ahead.
you can add something, it's your obligation to do that. It's otherwise you just pay a high amount of interest if they find it out after 3, 4, 5 years.
Yeah.
And you need to pay all those taxes plus the interests in the end. So at some point they will find it out usually. So it makes sense to proactively contact the tax authorities and ask them
proactively, right? Yeah, it's your obligation to disclose this. It's your obligation to find out if you should do it or not, and don't just play dumb in the end. Oh, I didn't know that I should do this, right? Okay. It's very clear. It's a good reminder, Kevin. And I know, for a lot of people, they know like in Switzerland and different cantons, the tax rules and regulations can be so different, right? And I think among expats, we also know that, for example, some cantons or cities, they are really famous for let's say kind of like better taxation, rules and regulations here and there as well. For example, like Zug, Schweiz, for example, right? And then some other some cantons in Bern, for example, you tend to pay more. Maybe you just want to also briefly touch a bit on that as well.
Yeah, so as I said at the beginning, the tax law is basically the same, more or less, in all of the cantons. There are just lower tax rates in some cantons and also in some cities within those cantons. So each canton has different tax rates, and each city has different tax rates.
Exactly. Yeah.
And additionally, and that is what makes it complicated, they also have within the tax return different lump sum deductions, for example. So there are higher deductions in one canton than in another for having a child or for your insurance premiums. So you cannot just compare the official tax rates to compare the cantons. You really need to get into the details. You need to prepare tax returns in both cantons to really be able to compare them properly.
Yeah, exactly. So as Kevin said, not only different cantons have different tax rates and different cities within one canton, it could be, definitely it's the case that they have different tax rules as well. So maybe, Kevin, we can touch a bit on the investment part as well. We know that we will have a deep dive in another episode for investment tax, and maybe here you can also briefly let us know just on a high level, how are investment incomes, like for example dividends, capital gains, and foreign investment tax here in Switzerland, from an expat's perspective.
Okay, so when it comes to expats, it's important that you need to check if your center of vital interest is in Switzerland or not. And if it is, so if you're planning to stay here for a longer time, you are fully taxable. So not only for your salary, but also on your investments, properties abroad need to be reported in the tax return. Also, if you have some investments abroad, like if these are US shares and not Swiss shares, doesn't matter. You have to report your worldwide income.
Yeah.
And
for example, now I'm an expat, right? And then if I have a house, for example, assume I have a house apartment in Hong Kong, in China, I need to tell the Swiss authority. If I have a bank account in Hong Kong or China or Singapore, I need to also let the local, government, the local authority know.
Yes, exactly. But here it's good to know that based on Swiss tax law and also on most double tax treaties, Switzerland does not have the right of taxation for foreign properties, for example. But they take it into account for the calculation of the applicable tax rate. So the tax rate is always based on your worldwide income and wealth. But foreign properties are not taxed in Switzerland. But this is the reason you need to report that.
The tax rate will likely be driven higher by more wealth globally that you have, but it may not exactly applies to that property or that foreign account that you have.
Exactly. Yeah. And this is totally different to other kind of investments. So shares, bank accounts, ETFs abroad, they are all fully taxable based on Swiss tax law and usually also based on on most double tax treaties that Switzerland has.
Okay. And if it comes to shares, for example, if I have, let's say, 500,000 shares, like, or ETF in Hong Kong, for example, for me, and it will not, like, as we know, capital gains, there's no tax, but dividends, I do not need to, pay, like, from the Switzerland's perspective. Do I understand correctly? But it may, affect on your rate, the tax rate.
No, I think we misunderstood each other in that point. You need to, or those assets, they are taxed. Only the property is not, like a house
Only
or
the property. Okay.
but if you have other kind of investments abroad, they're fully taxed. So if you receive some dividends from Hong Kong or the US or wherever, they're fully taxed in Switzerland.
Yeah, no matter where the investment platform you use, like the Hong Kong-based one or the Swiss, the Switzerland-based
no
one.
matter where the platform is or where the company is that you own the shares from. Sometimes the other country involved can charge a certain tax source on the dividends, which then can be offset against the Swiss tax burden usually. We have double tax treaties with most other relevant countries, or like those that you are usually dealing with. The standard here is 15%, which are deducted from the dividends and usually can be offset against the Swiss tax burden.
Yeah.
And I think you already mentioned it, Switzerland does not tax capital gains on any investments, only on if you sell a Swiss property, but all the other investments, all the other private investments are free of taxes, or the gains on them are free of taxes.
Yeah, I know. And, when it comes to expats, for example, as we mentioned, it's quite common. I would say a lot of expats here in Switzerland, they tend to have quite a high income, right? High income professionals. And for those people, and if I ask you, what are some of the most effective but underused tax deductions or strategies for them? What would you say, Kevin?
Okay. I think we have two parts here. One is when it comes to investments, and the other part is what
like
you
overall speaking. Yeah.
Exactly. So let's start with the investments. So as capital gains are not taxed, but dividends are, investments in assets or shares that do not pay out any dividends are beneficiary, of course. In this regard, funds are sometimes a bit risky, as they're basically just a basket of shares or other investments, because they reinvest the money, so it's just because they're accumulating and don't pay out dividends, that doesn't mean that that fund doesn't have a taxable income, because if there are shares within that fund that pay out dividends that are reinvested, this is still considered a taxable income. So you have to keep that in mind, that only because the fund itself does not distribute any dividend, it doesn't mean that it's
Exactly.
taxable.
Yeah. So basically, what Kevin wants to say is, like, no matter if you invest in accumulating or distribution shares, for a fund, as long as there are some dividend paying stocks within that fund, you need to pay the tax on the dividends that you receive, no matter if you really receive it, as cash, or they reinvest it with that dividend.
Exactly. Yeah, and in general, so not talking about investments, the deduction for employees are quite limited. So or are often linked to some kind of expense that you may have, or at least linked to blocked money, like in a pension fund, on your Pillar 3A account. So the first step for sure is to not forget any deductions that you're entitled to in your tax return. For example, that you deduct your commuting costs, your meal expenses, your childcare costs, for example, or any interests you may pay. So just that you don't forget any of these expenses that
Deduction. Yeah, I think a lot of people, they tend to forget,
Yeah.
especially, when it comes to meal, when it comes to commuting costs. They think, oh, it's so little, but when you accumulate, it could be,
Yeah,
affecting
often
you.
it's just small amounts, but as you said, when you accumulate them, it gets a certain amount then in the end. And yeah, the tax authorities, they review your tax return, but usually they don't make any adjustments in your favor.
Yes.
Sometimes they do when it's absolutely obvious that it's a mistake, when it's a
Mhm.
typo, for example, or when you submit the statement showing your interests paid, they usually add it when they see it, but they don't need to. So that's maybe the most important point. Don't forget any deductions in your tax return. And then the second step is planning, for example, contributions to the social security system like Pillar 3A, or maybe do some renovations of your properties. And there, when you're talking about social security contributions, renovation of your properties, there a clever strategy can save a lot of money without expanding more. Like, it just can make
And
sense.
can save you thousands of
Yeah,
Swiss
yeah,
francs, for example.
just by having a strategy to have those expenses in different years or all in one year. It really depends there on your personal situation, on the other sources of income you have. But yeah, it makes sense to plan those things.
Yeah, if I could just summarize very quickly, I think the first thing, when it comes to, how to optimize your tax as a busy professional or as an expat, the first thing is that you really need to know that when it comes to investments, and if your, also depends on your investment goals, right? And if you don't have to touch, for example, on dividends, and if it doesn't really in line with your investment goals, it's better to kind of like consider some more like growth oriented shares or ETFs or funds instead of dividends or interest focused assets, because in Switzerland you need to pay tax on that. And in general, for example, don't forget to deduct your, all those kind of, expenses, commuting costs, meal deduction, and children, like child care, right? What we talk about, and also Pillar 3A and renovation of your property. It can also be deductible.
Yeah, and I mean, for an expat, I really recommend that for the first tax return that they need to file, get professional help,
Yeah.
because then you have one proper tax return. You see what deductions are possible, and second year you can just copy it more or
Do
less.
it by yourself. Oh,
Yeah,
yeah, it's a really a
demand.
great tip. Yeah. And also when it comes to professionals in Switzerland, no matter if you're an expat or not, or you are just a local, how can those people, use the Swiss pension system? Like we just mentioned the third pillar, right? And I would say especially the third pillar for tax efficiency. Is there any, tricks and tips here and there as well?
Yeah, so for most Swiss employees, the pension fund is mandatory if your annual income is about both 22,680 Swiss francs a year.
Yeah.
Uh, and if this is the case, your contributions to Pillar 3A are limited to 7,258 Swiss francs a year.
Yeah,
And
it's the updated number in 2025,
yeah,
and this number can be, varied
it,
for
it
different years.
every every year, basically. It's related to the pension payments of the first pillar. But
Yeah.
that's a different topic. So it usually makes sense to make those maximum contributions into the Pillar 3A. And I personally recommend doing it at the bank instead of doing it at an insurance company.
Exactly. I mean, a bank or a third party, invest like a
Yeah,
platform, right? Instead of insurance company.
yeah.
That's what I totally believe as well, Kevin.
Perfect. No, because when it's not that bad when you do it at an insurance company, but you pay just fixed monthly premiums, and I think the return on investment usually is
Yeah,
lower.
it's really low. Yeah.
Yeah, and also it's just a fixed time you have to pay those monthly premiums or yearly premiums. So you have a contract that you pay them until the age of 65 or 64 or whatever it is. And if you want to, or if you need to withdraw the money at an earlier point, for example, when you
Yeah.
would to buy a property in Switzerland, you lose so much money. And
Yeah. It's like there are some penalties, I believe, as well, right?
exactly. And therefore, I personally recommend doing it at the bank or, yeah,
Or a
whatever.
third party platform. Yeah.
Yeah. Because you're absolutely flexible how much that you would like to contribute into this Pillar 3A. For example, if you have 1 year where you don't earn a lot of money, or where you have to renovate your whole property, and your taxable income is close to zero, it doesn't make sense to contribute into your Pillar 3A, because you don't
There's no
save.
tax benefits. Yeah.
Exactly. Therefore, yeah, you're just more flexible, and you can adjust your payments. In this regard, maybe it's important to know for expats that in the first 5 years after moving to Switzerland, if you would like to make contributions to the pension fund, so second pillar, they are quite limited to 20% of your salary. After that, there are limits as well, but they're quite high, depending on your salary and your current balance. So what you've already paid into your pension fund. But for additional contributions into the pension fund, so second pillar, I highly recommend to consult a tax advisor or financial planner.
Yeah.
Because here, yeah, clever planning can
It
save.
could be, depends on a lot of factors, right? Like,
Yeah,
for example, yes, you can pay in, or what we call like buy in, like in the second pillar, you can, because you miss a lot of working years in Switzerland, right? And you can save tax because your taxable income will be reduced. But over the long term, like the money sits in the pension fund, and usually it gives you really, really little or mediocre returns, and you may miss on the upside. So it depends on a lot of factors, like
yeah,
how many years you still have, on your, how many years do you want to stay in Switzerland, and then how many years you still want to work, before you plan to retire for retirement. So a lot of factors. That's the
yeah.
reason why, it's really based on individuals.
That,
Okay. And maybe we can talk a little bit on the real estate and tax planning, regarding properties, because like as we know, a lot of professionals in Switzerland, basically either we bought a property or we rent, right? So is there anything that I would say, what should someone know about tax impact of buying, renting out, or let's say selling real estate in Switzerland?
yeah. So buying a property has an impact on your income, so the taxable income, and on the wealth as well. So we have those two sides.
Mm.
So we start with the income side, which has much higher influence on your tax burden.
Yeah.
If you rent it out, for example, the rental income would be taxable. But also if you live in the property by yourself,
Yes.
there
It's something a lot of people they feel so surprised, right, at the very beginning when they realize this. Okay, over to you, Kevin.
yeah,
Sorry.
so yeah, it's called Eigenmietwert in German. I
Mm,
think it's
yeah.
translated in deemed rental income. It's just a fictional rent, in the sense of a compensation for the fact that you no longer have to pay rent,
Mm,
and or that you do not generate any other income like dividends with the assets, that you could also have the money invested instead of the property. So this is just an additional income. Usually it's about 70% of a rental income that you could receive for such an apartment
of the
or
market price. Okay.
yeah. So it's not that high. And on the
Mm,
other side, you can make deductions. So you can deduct your repair and maintenance costs as well as energy saving investments. Um,
and interest.
yeah, you can deduct the interests on your mortgage. In years without any expenses, like repair and maintenance costs, you can claim for a lump sum deduction instead, which
Mm,
in most cantons 20% of this income. So if you earn 20,000 Swiss francs a year, only maximum 80% of that are actually taxed then in the end. Plus you can deduct the interest as you mentioned. So it has an impact on your income, which is slightly higher than usually.
mm,
Uh, on the wealth side, each property has a taxable value, which is not, or which is much lower than the actual price or the fair market value
mhm,
of the property. The discount is usually about 30 to 40 percent, sometimes even higher for older properties. So sometimes I see properties which have a value of probably around 2 million or whatever, and
mm.
they're only taxed with a value of six or seven hundred
Oh,
thousand
okay. For
francs
some
because
older ones. Okay.
yeah, because they don't change that annually. They just have a kind of
Yeah,
an
they
old.
put its value for 10, 20, 30
Yeah,
years, right?
yeah.
Okay.
Yes, and therefore buying a property usually lowers your wealth tax. So you can
Yeah.
also deduct the mortgage, which you may have. So on the wealth side, it lowers your taxes. On the income side, it usually
Increase,
increases
right?
your taxes. But
Yeah,
also here,
exactly.
it depends on your situation. When you buy an old house, for example, where you need to do a lot of renovation, or like energy saving investments, like
Mm.
proper windows, then you can deduct those costs, and this could in the end lead to a lower taxable
Yeah.
income
So there are
before.
some exceptions, right?
Yeah,
For sure. Yeah. But what we need to know is like if you really buy a property in Switzerland, no matter if you rent it out to someone else, if you can, or if you live in it by yourself, you need to pay income tax. They will assume that anyways, you rent it out to someone else or to yourself. I
yeah.
think it's something that really surprised a lot of people when they first, came here in Switzerland. And when it comes to expats, Kevin, and definitely a lot of us, we will kind of like counter, I would say, some cross-border tax issues, right? Like as an expat, like if your home country is, for example, in the US or in Asia, so or let's say in Europe, some other European countries. So I would like to ask you, gather your opinions on, what are, let's say, common mistakes or challenges for people with income or investments abroad, when it comes to cross-border tax issues?
Yeah. So it depends a bit if we are talking about the salary or just income from investments. A common mistake is that they just forget to claim back foreign taxes on their investment income. So I think this is the thing that I see the most. We talked about those 15% interest and not interest taxes that most of the countries have on their dividends. So a lot of in a lot of tax returns that I see, they forget to claim that money back. Um,
Yeah,
so
so actually it can, like theoretically, if you have a lot of assets, for example, in the US, and then the government, they charge 15% withholding tax, you can actually, reclaim it back, when you file proper, tax forms in Switzerland. But a lot of people, they just tend to forget about it at all.
yeah, and when it comes to the salary, I mean, we talked about it. A lot of people just forget to claim for the normal deductions like commuting costs, like meal deductions. But also, for example, if you're relatively new to Switzerland and maybe you came to Switzerland and you still work for the same employer, so you're just on an assignment or something like that, or you just got a new job in Switzerland from your employer, you often receive a bonus for the last year's work, or you participate in some kind of employee participation plan where you receive shares, RSUs, or options. And often a portion of that is not taxable in Switzerland because maybe the grant to vest period of those options or RSUs was partly when you were living abroad. So Switzerland doesn't have the right of taxation for the full amount. Yeah, this would get too much into detail now to explain that. But if you're new to Switzerland and you profit from such a plan, or you receive some bonus from previous years, just contact a tax advisor and have a proper review, because otherwise often the other country taxes it at source and you declare it in your tax return, and nobody knows that it already has been taxed, so it's taxed twice in the end.
Yeah, and then in a lot of cases, and if you don't do it properly, you may, lose quite a bit money, on that front as well. And Kevin, talking about tips and trips, I think let's just assume we are quite new to Switzerland. And when it comes to tax seasons, I think it really generates a lot of stress and I would say pressure, stress across the board. So if I ask you, what are the most important things to keep in mind during tax season to avoid this kind of stress and penalties, especially for those newcomers? What would you say?
Yeah, not only for the newcomers, but keep in mind the deadlines.
For locals as well.
Yeah, yeah, because some cantons are quite relaxed in this regard, and but others.
Really, which one? Okay, let's not name them. It's like pointing fingers, like you didn't do a good job. You're too relaxed.
No, but you can extend the deadline in every canton, and often you can do it easily online on their platform, or you can just give them a call. Some cantons are a bit more generous than others. Zug, for example, is quite relaxed. You can tell them,
Zug, okay.
I will only be able to submit my tax return in November. Is that fine? Usually that's fine, because as long as you're in contact with them and they know we will get it in November, they're fine. So they just want to know that you are aware of that, and that they will receive the tax return at some point. Other cantons like Zurich, for example, are a bit, let's say, harder. There, for example, you cannot extend a deadline that already has how do you name it?
So it's already a
And you
general
already
offer,
missed
so you
the
cannot
deadline.
further extend it.
Yeah. So when you already missed the deadline, you cannot extend it in Zurich, for example. So there it's very important to keep the deadline in mind. So it's the end of March for the submission of the tax return. In other cantons, when you call them in June, they're fine with that. They will still extend the deadline. Zurich is quite strict.
Yeah. So I would say a general rule or tip here is like if you want to extend, do it before the deadline, right? And then usually if it allows, it will. You can have a extended period of time.
Yeah.
And Kevin, I think one more thing before I let you go is it's really a common misconception, like especially when it comes to marriage in Switzerland. So I would say, we constantly heard, I would say from news as well, people don't want to get married in Switzerland because there is such thing called marriage penalty. But actually, it's not as simple as, what you may, have known as well. Maybe Kevin, you want to quickly touch on this point as well?
Yeah. So it's kind of a myth, this so-called marriage penalty. I think it only affects like I've seen some tables somewhere. I think it's about 5 to 10% which pay more taxes when they're married than they did before. Tax rates in Switzerland are in general progressive, so they are higher the higher your income or wealth is. And the rates for married people are a bit lower.
Yeah,
But
when you group your two income together, right?
yeah. But nevertheless, when there are double earners, then they reach a higher tax bracket and therefore can pay more taxes than did before. But that's really only a few people. For example, if only one of the two is working, they benefit from the lower taxes as married people, because before the person working would have a higher tax rate, the other person which did not work have paid taxes at all. And now those incomes are added, so it remains just his or her income, and they are then at a lower tax rate in the end. So it really depends on your personal situation, if you're a single earner or double earner. Also, if you're a double earner and you were already in a very, very high tax bracket, you won't pay more taxes after marriage, because there's a certain limit. So if you're at the maximum, you won't pay more when you have both incomes. So it can be a disadvantage for some people, but for most people it's not. So
It's not the big issue, right? Yeah, and when we talk about marriage penalty, and it mainly means that as two persons after you get married, you actually together you pay more tax than a single person. I mean, two single persons together. And in reality, actually, they're like Kevin mentioned. If according to the data, it's mainly only like 5 to 10% are like 5 to 10% cases are like that. And the most majority, actually, when you get married, actually you pay less tax or quite similar to before when both persons are single. And if we see different cases, for example, it tends to be like this. If one person earns quite a decent salary, maybe let's just assume 200K, and then the other one earns 50K or zero, and then very likely, there are definitely some exceptions here and there, right? But very likely these two persons, after they get married, because of the together, the tax rate will be a bit lower than for single persons, and very likely they will pay less tax than before, like two added up together, right? But let's say two persons, they earn quite a, like both are, earn maybe 200K, I guess. And then when you add it up together, maybe you will pay more tax. Can I kind of like generalize it like this?
That's it. It's really a quite individual thing in the end. It depends on each income. And on the other side, I mean, even if there's this marriage penalty, you should not only focus on the taxes. You have some benefits also on the other side regarding the pension or other kind of stuff where it's just easier to be married. So yeah, in my opinion, taxes here are secondary as well.
Yeah. Like for example, what I, as far as I know, for example, the first pillar, right? After you get married, if both, contribute fully, over the, let's say, work in Switzerland for over 40 years, for example, like that in these cases, and together you receive less, right, than two single persons separately.
Yeah. So there you receive less. On the other side, if you're married and let's say the husband dies, you receive a pension if you've been married, and if you but if you've not been married, you would not receive any pension at all. So, and there are
there are a lot of insurance, pension, this kind of considerations.
And also when it comes to if you have taxes on gifts, for example. So if I want to make a gift of $1 million to my girlfriend, it would be taxed. If we're married, it's tax free. So so these are all topics that you need to keep in mind when when you're talking about the marriage penalty. So
yeah, exactly. I think it makes total sense. Although a lot of people, they would like to, see marriage, for example, from a financial perspective. Actually, there are a lot of aspects from a financial perspective, beyond tax, I would say, right? Like what Kevin mentioned, gifts, right? And also pension, and insurance as well, instead of just pure tax when you consider marriage from a finance perspective.
Exactly. Yeah. Also, if you die, for example, and the inheritance, it's taxed totally different if you're married or not, and also just by law if you receive any inheritance or not. Depends on if you're married or not. So you just have to keep in mind a lot of different topics, and not
instead of just pure tax. Yeah.
Exactly.
There are definitely a lot of pros and cons, and depending on your own, individual cases. Okay, Kevin, I think, we really learned a lot today from you. Is there anything else you wanted to add before we let you go?
I think we're fine. If you
Very
don't
good.
have any more questions,
Yeah, that's great. And then we will also put your social link at the description of this video. And for our audience, if they think, they have any specific cases, they will reach out to you directly. Thank you so much, Kevin, for joining us.
Bye-bye.
Yeah, until next time. Ciao.